Welcome to Fundu Money. Here we will discuss why falling markets or correcting markets or bear markets are a perfect time for investors to consider exchange traded funds or index funds. So what basically we want to discuss here is why index investing or passive investing, as some people call it, is a great way to stay invested in equities through mutual funds and of course gain from equities even as markets are correcting or they're volatile, things are going up and down. Typically it is in this backdrop, in this background, people feel a little unsure about how they should be going about their equity investment as far as fresh investments are concerned, and definitely their existing investments. So here what we are going to discuss is index funds or exchange traded funds, where the money of investors which is pooled in is actually invested in stocks in the same proportion as the index that they are tracking. And here of course we'll be stressing on the standard sort of index, say a Nifty 50 or Nifty Next 50 kind of standard sort of index, not the indices that are created by fund houses or other organizations, and then of course the investments are done accordingly. So we will be telling you why the standard sort of well diversified investing through index funds or exchange traded funds gives you the kind of benefits that help you in the long term and let you stay invested in equities and actually benefit a lot from them and exploit these conditions, and as well as make sure that you keep gaining from the high growth, long-term high growth in equities. So we'll be discussing this. Now, what is the backdrop? Backdrop is, at the moment there are markets are volatile. There is a issue of high inflation and higher rates. There's a pressure on global economic growth. So all this is having does have an impact on equity markets. On the minimum, they make them volatile. There are periods when corrections happen, so that does make investors nervous. All these issues that give you concern, index funds or exchange traded funds, which are basically index funds which are listed in the markets and traded like shares. So they actually, both of them help you, and we will discuss the various things that are going in favor of index funds and exchange traded funds, and this is a normal trend, normal behavior. Lots of smart investors actually in such times do move into exchange traded funds or index funds. And this has happened in the past, it's happening now, and maybe you should be taking a very good look at it. So we'll be discussing the details. We'll be discussing about some of the advantages that exchange traded funds are offering. The background is also this, that if you start comparing with pure sort of equity funds, be it large cap, mid cap, small cap, the regular kinds, not the flexi cap with possible exception. If you look at their 1 year, 3 year, 5 year sort of performances vis-a-vis their benchmarks, you'll find most of them are not doing well. They're lagging behind their benchmarks. They are outperformers, of course, but when you compare them with actually index funds, you find or ETFs, you will find that index funds are actually doing better, and that's simply because of the current circumstances, and it's something, these kind of funds are something that should be there to make sure that you get a baseline sort of return during such times, like the times that we are right now going through. So in the next section we'll be discussing the details. Before we split for a small break, we will just request you to subscribe to our channel and get connected with us on all leading social media networks. So we'll be back shortly with some of the reasons, and there are quite a few, as to why you should be actively looking at index funds or exchange traded funds and how they sort of help you. So we'll be back shortly. Don't go away. Welcome back. Welcome to Fund to Money. We're discussing why index funds or exchange traded funds, basically index investing, they work so well in bear markets or correcting markets, volatile markets, how they help you in such times when things are going up and down and you're wondering what to do about your fresh investments, what to do with the existing investments. Of course, in index funds, even when equity markets are behaving like this, not the way you would prefer them to behave, they are a very attractive alternative. Let's look at the reasons one by one. What if you have a long-term sort of a horizon? If you're looking at about 8-10 years, they're really appropriate. And so the first thing is about index funds is they're very well diversified. So a Nifty 50 kind of an index, which has got not a narrow one, and it's a well established index. It's widely followed. Those are the indices that you're looking at. Even for international index sort of funds, if you're looking at, you should be looking at a widely followed sort of index, S&P 500, FTSE and the like. So those are the indices that you should be looking at. So they are very well diversified. So all kinds of companies are there, all kinds of different sectors are there. They are large companies, they're well performing companies, they're mature companies. Very importantly, they are not some companies where you would expect them to start giving you the kind of returns or the kind of financial rewards sometime in the future. They're already there. So therefore, what's happening is during such times as the kind of times that we are right now in, you want a little more stability in returns. And for equities, of course, it's because it's a volatile asset class. This is one way by which you can ensure that you're there in equities, yet there is less fluctuation in returns. And because of the nature, because in an index there you have all kinds of stocks, there might be some sectors which are have more weight, say banking or something like that in India, but what you do is, what happens is, it's spread across sectors. They're mature businesses, they're well performing, and compared to say a sort of a mid cap or a small cap where things might just be moving ahead, they're not there in a mature phase. So that automatic diversification happens. You also don't have to keep tracking of each stock. So if you have invested even in these companies individually, you have to keep following these stocks. Here you don't have to do. What happens if a company does badly, starts performing badly at the stock market, it gets replaced by another company. So this automatic diversification is happening. Things are happening automatically. They constitute a large chunk of the market. So a standard sort of index, or the say a Nifty Next 50, they represent a very large chunk of the market. And when you are invested in a index fund or an ETF which is actually tracking this and investing according to it, following it, then what's happening is you're actually investing in say Indian equities, if we can say that, because they are actually representing the market. They're actually representing the most successful companies in the country. So some of them might be providing dividends, they are growing well, they typically have the wherewithal to withstand any kind of a negative surprise, because they're the largest around. So therefore you are really betting on the champions, right? Of course, because that's happening, therefore the fluctuations are lower. So you don't have this zigzagging that can worry you, concern you. It doesn't happen. Of course, when the markets go up, they will not rise at the same rate as some of the other ones, where the risk is more. You're looking at certain fund managers or looking at certain sectors or certain stocks. But what happens in times like this, your fluctuation is less and you're getting possibly the best deal that you can get out of equity investing, right? So So the fluctuations are lesser, deviations are lesser from average, and basically these are the best stocks. You're getting them at the lowest possible prices. Why? Because the mutual fund advantage, remember, lots of people are pooling in money. You are being able to buy stocks that some people or you might not be able to think about doing it, partly because of financial constraints, partly because you don't have the expertise. You're getting all that done, and it's helping you, right? There are lots of choices as far as index funds and ETFs are concerned. We are talking about the standard, largely followed indices, right? Which is where it's not been created by any organization or fund managers for whatever reason. Now, what this also does, it makes the cost lesser, because the fund manager or the fund management team just has to follow. So the number of things, extra things that have to be done is really not there. So what happens is, even compared to a fund where a fund manager and his fund manager or her team is doing a lot of work and might be doing great, achieving great results, here what's happening is, because you have decided not to do that, the costs are lesser. Because the costs are lesser, whatever you're getting, whatever your fund is earning, most of it is coming to you. And in such a fund, the key part that you need to look for, these are again the advantages, of course, is that whatever is the index, the return, say a Nifty total return index, or whatever is the index, you have to make sure that the fund the index fund or the ETF, its performance is as close, as near as possible. The larger the gap, more you should be looking away from a fund, because they are supposed to be tracking that index, and that error, the gap should not be too much. Once you start comparing the performances between actual performance over 1 year, 3 year, 5 year, and the index return, if the gap is very less comparatively, those are the funds that you should be looking at. So it should be well diversified, widely followed index, whether it's in India or abroad, and of course the difference has to be less. The cost automatically, if it's a standard sort of an index, then the cost should automatically be lower. And the track record, how well the fund house has been, or the fund has been matching the returns from the index it follows. So these are very important things that you need to keep in mind. The other thing is that apart from the low cost, because of the fund, you would hear a fund manager typically will help you earn the extra returns. When you're following an index, you can also do it yourself, of course, if you have the time. But here what's happening is, rather in other kind of actively managed funds, where the fund manager has got a philosophy, has a theme. So what's happening is, it's based on that fund management principle, decision, house strategy. So when the economy is going through the kind of turbulence, the global economy is going through the kind of turbulence that it is doing now, with inflation being high, rates rising, global economic uncertainty, slowdown, conflicts happening, supply chain issues. Therefore, what's happening is, even if it's an expert who's taking the decision, chances of getting it wrong are reasonably high. So what you're doing is, you're making sure that you're not taking that risk, and making sure whatever you can get from equities or stocks as a whole, you get that return. At least you get that, and you're not taking the risk of shall we say, you're not venturing out and trying to get that extra bit of return from the fund manager's skill. So it's not a bad take at a time when anybody can falter. Even you can falter, even if you are very well qualified. The other thing, of course, is here, because it's so well diversified, the index funds and ETFs that we are talking about, you don't have to track how things are happening, which sector is doing, which is going up, which is going down. If the markets as a whole, they go up, they will take your investments up with you, right? The other thing is, the typical advantages of mutual fund investing, regular investing, actually also apply, because if markets are correcting, going down, you're buying larger number of units, and if you're buying these units on a regular basis, what's happening is when the markets will go up, you'll buy lesser units, and of course in the long term the average cost of buying the units will go down, and of course you'll gain as the markets on a long term basis they go up. So that benefit is happening, and here because you're doing that, you're actually buying far more units than you would have done, because in a correcting market. So it's a great time to get started, and if it remains like this, you will end up buying, it will be a very cost efficient way of buying units, and of course over a period of time you can expect to gain. Now if you haven't ever invested in equities, and you're thinking whether it's a time to do this or not, and you're pretty young, you've started your work life, ETFs and index funds are the best, and the ones that we are talking about, even in these times you can do that. And the whole process of regular investments will make sure that whenever the markets go up, you benefit. And because widely diversified, widely representative indices are the ones we are talking about in terms of index funds and ETFs, they represent a large chunk of the market. So you're actually investing in equities, and equities, as we know, if the economy is going to do well, it's a good punt that equities will do well, because if economic growth is doing well, is improving, then your large companies are the first guys who are going to start doing very well. So what's happening is, anytime there's an upsurge, an acceleration of economic growth, then what's happens is your investments gain that much more. And then of course, as things settle down, you can again look at higher risk investments, say a mid-cap funds, or so on and so forth. So it's a terrific entry level investing option. What you are basically doing, and a lot of people, when they talk about index investing, you're investing in you're not trying to become a market genius. You're not trying to figure out when the market is going to drop and you're going to buy some more units. That's not what you're supposed to do. You're not trying to become a market genius, but you're relying on the genius of the market, which basically means you know that if you stay invested for the long term, you're bound to benefit. So these are some of the things which are going so well for index funds and exchange traded funds. We hope you found this useful. Just in case you were thinking whether you should be getting out of booking a little bit of profit and getting out of equities, the idea is, if you want to get out of if you want to reduce the risk, you can move some amount of your funds into index funds from your high risk investments, and you can high risk equity investments, and you can go put them here, and then when things settle down, maybe you can again do a reevaluation. And for fresh investments, you can still invest in equities. You need not stop investing in equities, and you can do it through this, because it will keep the fluctuations and the risk at manageable levels. So we sincerely hope you found this useful. If you've liked it, hit the like button and share it with others. Follow our various playlists. Check out our various discussions on a wide range of topics on personal finance. Till the next time, take very good care of yourself, and goodbye.